Important update: the IRS has officially set the start of tax filing for 2026. And this year, I need to be very clear with you. The rules are not working the way they used to. They've changed in significant ways that affect almost everyone. Filing too early or filing without fully understanding what changed could delay your refund by weeks or even months, or cause problems you didn't expect and didn't prepare for. New deductions can absolutely help you and put more money back in your pocket, but other changes can quietly work against you if you're not prepared and don't know what to look for. And that overlap, that intersection between helpful changes and potential pitfalls, is exactly where people get caught off guard every single year. If you rely on your tax refund to cover important expenses, if you want to avoid delays that could affect your finances, or if you simply want to make sure you're not leaving money on the table or making costly mistakes. This matters right now. This is information you need before you file, not after. Quick question before we get going, and I'm genuinely curious about this. When you usually file your taxes, do you try to do it as soon as possible, like the minute you get your W-2 in the mail or your inbox? Or do you tend to wait a bit, maybe until March or even closer to the April deadline? Let me know in the comments. I'm always curious how people handle this because there's no one right answer, and this year, especially, timing matters more than usual. So, here's what you need to know right away. January 26th is the first day the IRS will officially accept and process tax returns for the 2025 tax year. That's the official start of the 2026 tax filing season. Mark that date on your calendar if you haven't already. And on the surface, okay, that sounds perfectly normal, right? Tax season starts in late January. Just like it usually does, we've seen this pattern for years. But what makes this year genuinely different, what makes this filing season stand out from previous years, is what's happening behind the scenes that most people aren't aware of yet. We've got major tax law changes that were signed into law last summer and are now taking effect. We've got fewer IRS workers than we had last year, significantly fewer, which affects processing times and customer service. And we've even got a shift in how refunds are paid out, moving away from paper checks toward electronic payments. All of that together, all of those factors combined, makes this season more complicated, more nuanced, and frankly more challenging than usual. And for a lot of people, for millions of American households, tax season isn't just paperwork and forms and numbers on a screen, it's a major financial moment. That refund for many households is the largest lump sum payment they receive all year long. It might go toward paying rent that's due, catching up on bills that have been piling up, paying off a credit card that's been carrying a balance, or just finally building a small emergency cushion in savings. And with prices still elevated for food, housing, healthcare, childcare, and just about everything else, there's a lot riding on this. Getting your refund on time and getting the full amount you're entitled to can make a real difference in your financial stability over the next few months. Now, one of the biggest reasons, probably the single biggest reason why this tax season is so different from previous years, is the new tax law that President Donald Trump signed last summer. It's officially called the One Big Beautiful Bill Act, and yes, that's the actual name of the legislation. This law made wide-ranging changes to deductions, credits, income thresholds, and various other parts of the tax code. And those changes, all of them apply directly to the taxes you're about to file right now for the 2025 tax year. Some of these changes sound straightforward when you read them in a headline or hear them described in a news segment, but in practice, when you're actually sitting down to fill out your tax return or working with a tax preparer, they add layers of complexity that can be confusing if you're not prepared. For example, and this is a big one that's getting a lot of attention, there are now new deductions specifically designed for certain types of income that weren't deductible before. There's a deduction for people who earn tips as part of their income, there's a deduction for people who work overtime hours, and there's even a deduction for people who have car loans under certain circumstances. Let me break those down for you specifically so you understand exactly what we're talking about. Workers who receive tips, This includes servers, bartenders, hairstylists, delivery drivers, and many others in service industries, may be able to deduct up to $25,000 of that tip income. That's a substantial deduction that could significantly lower taxable income for millions of workers. Overtime pay, the extra money you earn when you work more than 40 hours a week or beyond your regular scheduled hours, can now be deducted up to $12,500. Again, that's a meaningful amount for people who regularly work overtime to make ends meet or to get ahead financially. And if you have a qualifying auto loan, if you financed a vehicle purchase, you may be able to deduct up to $10,000 in interest paid on that loan. This is similar to the mortgage interest deduction, but applied to car loans, which is a new concept in the tax code. And all of that sounds great, right? More deductions mean lower taxable income, which means lower taxes owed or a bigger refund. In theory, this should be simple and helpful, but here's the catch, and this is critical. Employers didn't update their withholding tables after this law passed. The payroll systems that calculate how much tax to take out of each paycheck didn't get updated to reflect these new deductions. That means a lot of paychecks throughout 2025 may not have reflected these changes correctly. So some people, possibly millions of people, had more taxes taken out of their paychecks than was actually necessary without even realizing it was happening. Now, on one hand, that can lead to a bigger refund when you file, which sounds nice. Who doesn't want a bigger refund? But it also increases the risk of mistakes and complications if your W-2 form, the document your employer sends you showing your wages and withholding, isn't reported correctly. Or if you claim a deduction that wasn't documented the right way by your employer, or if the IRS systems flag something as inconsistent that can slow down your entire return. And with the IRS running with significantly fewer staff members than in previous years, delays can stretch much longer than people expect. What might have taken a few weeks to resolve last year could take a month or 2 months this year. Let me walk through the other major changes so you have a complete picture of what's different this year. The standard deduction has increased significantly. For individuals filing as single, the standard deduction is now $15,850. For married couples filing jointly, it's $31,500. That's a notable jump from previous years. That increase alone could lower taxable income substantially for a lot of people, especially those who don't itemize deductions. And remember, the vast majority of taxpayers, we're talking about 85% to 90%, take the standard deduction rather than itemizing. So this change affects almost everyone. The child tax credit has also increased to $2,200 per qualifying child. That's up from $2,000 in previous years. For families with multiple children, this can make a meaningful difference in their final refund or tax bill. A family with 3 children, for example, could see an extra $600 in total child tax credits compared to last year, all else being equal. That's real money that can help with school supplies, clothing, activities, or just general household expenses. Then there's the SALT deduction, which stands for State and Local Tax Deduction. This is the amount you can deduct for state income taxes and local property taxes. Previously, this deduction was capped at $10,000, which was limiting for people in high tax states like California, New York, New Jersey, Connecticut, and Illinois. The new law has increased that cap dramatically to $40,000, and this increase is in effect at least through 2029. Now, this change mostly affects people in higher tax states and middle to upper middle income households who itemize their deductions. If you take the standard deduction, the SALT cap doesn't affect you at all. But according to estimates from tax policy organizations, some families earning between $200,000 and $500,000 per year could save around $1,200 or more this year just from that change alone. For upper middle class households in expensive states, this is a significant benefit. The administration has said publicly that these updates are meant to provide targeted relief to working families, seniors, and middle income earners. Acting IRS Commissioner Scott Bessent stated in a press release that the goal was to build on last year's filing season and improve outcomes for taxpayers while also ensuring the tax system remains fair and supports economic growth. And to be fair to the IRS, they say they've been preparing for months since last fall to update their computer systems, forms, publications, and processing procedures. Significant resources have been devoted to implementing these changes. But here's where things get a little tricky. And this is where the practical reality diverges from the ideal scenario. Even if the computer systems are updated and working perfectly, the human side of the IRS has taken a serious hit this year. The agency is entering this filing season with roughly one quarter fewer employees compared to last year. That's a 25% reduction in workforce. Units that handle return processing, customer service phone lines, correspondence, and problem resolution are all smaller, sometimes significantly smaller than they were just 12 months ago. So, what does that mean for you in practical terms? It means accuracy matters more than ever. A small mistake, something that might have been caught and resolved quickly in the past, could now result in weeks or even months of waiting while your return sits in a queue waiting for a human reviewer to look at it. One tax expert I read recently put it perfectly when he said, accuracy this year should be more like 110%. Not just good enough, not close enough. It needs to be exactly right. And this is why you're hearing more tax professionals, CPAs, enrolled agents, and even IRS officials themselves say, don't rush. Filing early isn't always filing smart, especially this year. Taking your time, double checking everything, and making sure you have all your documents before you file can save you enormous headaches later. Another thing that's changing this year, and this one is actually quite big for certain groups of taxpayers, is how refunds are paid out. The IRS is actively moving away from paper checks sent through the mail. Last year, approximately 9.5 million people still received their refund by traditional paper check. That's still a significant number of people, but the IRS is making a concerted effort to phase this out. Going forward, direct deposit into a bank account is strongly encouraged and in most cases expected. If you file your return without providing bank account information for direct deposit, the IRS may send you a letter asking you to provide it. There may be some limited exceptions for people who genuinely don't have access to banking, and the IRS has mentioned they're exploring alternatives like prepaid debit cards or digital wallets. But electronic deposit is now the default path. And honestly, from a practical standpoint, it's faster and safer. Direct deposit refunds usually arrive within about 21 days if your return is straightforward and there are no issues. Paper checks, on the other hand, can take 6 weeks or longer to arrive in the mail, and that's assuming everything goes smoothly with no problems. Plus, paper checks can get lost in the mail, stolen from mailboxes, or delayed by postal service issues. Direct deposit eliminates all of those risks. So if you've been avoiding setting up direct deposit for your refund, if you've been getting paper checks because that's just what you've always done, this might be the year to reconsider. Even just opening a basic checking account at a local bank or credit union, which often has minimal or no fees, can make this entire process much easier and faster for you. Now let's talk about timing and why waiting a little bit before you file might actually help you avoid problems and ensure you get your maximum refund. A lot of tax credits and deductions require supporting documents that don't always arrive in January. They come later. If you claimed energy credits for solar panels you installed on your home efficiency upgrades like new windows or insulation, or electric vehicle purchases, you may need extra paperwork, receipts, certification forms, or manufacturer statements that take time to arrive. Retirement contributions, especially for higher earners who are near income phase-out thresholds, also come with updated limits and phase-out calculations that are easier to miscalculate if you rush through them early in the season. The IRS saw a significant surge in amended returns early last year, meaning people who filed their taxes, got them processed, and then realized later they made a mistake and had to file an amended return to correct it. And amended returns almost always mean delays, often substantial delays. Again, with fewer staff members at the IRS, those delays could be even longer this year. An amended return that might have been processed in 8 to 12 weeks last year could take 16 to 20 weeks or more this year. And I've seen this personally in conversations with people I know, friends, family members, viewers who've shared their stories. People get excited. They see that their W 2 is available online and they file immediately, often within days. And then a few weeks later, they're scrambling because a corrected W 2 form arrives in the mail, or a 1099 form for investment income shows up, or they realize they overlooked a deduction or credit they qualified for. That's incredibly frustrating, and it's completely avoidable if you just take your time. After all, you still have until April 15th to file your tax return without any penalty. That's nearly 3 months from when filing opens. There's no prize for being first. There's no bonus for filing in January. The IRS doesn't process returns faster just because you filed early. And if you need even more time beyond April 15th, you can file for an extension that gives you until October 15th. Just remember, and this is important, an extension gives you more time to file your paperwork, not more time to pay any taxes you owe. If you owe taxes, you still need to estimate how much you owe and pay that amount by April 15th to avoid penalties and interest charges. Another thing to keep in mind, and this is just about setting realistic expectations, is customer service. If something does go wrong with your return, if there's a problem that needs to be resolved, calling the IRS may take longer than it used to. Phone wait times have increased. The average wait time to speak to a live person at the IRS was over 30 minutes last year, and some people reported waiting hours. With fewer staff this year, that could get worse. I'm not saying this to scare you or to make you anxious. I'm saying it to set expectations so you're not caught off guard. Being patient and thorough up front when you're preparing and filing your return can save you from having to deal with all of that later. Double checking your math, reviewing your forms carefully, making sure all your documents match up, ensuring you qualify for the deductions and credits you're claiming. All of that work on the front end can prevent problems that would require you to call the IRS and wait on hold. So, yeah, this filing season isn't a sprint where the fastest person wins. It's more like carefully walking through unfamiliar terrain where one misstep could cause problems. The rules changed significantly. The computer systems at the IRS changed, the staffing levels changed, and how refunds are paid changed. All of that adds up to a season where taking a breath, slowing down, double checking your forms, and making sure you really qualify for the deductions you're claiming can make a huge difference in whether your return goes smoothly or turns into a months-long ordeal. And something else worth saying, and this is a perspective that often gets overlooked. A big refund isn't always a sign that you did something amazing or that you're great at taxes. Sometimes a large refund just means that too much money was withheld from your paycheck all year long. You essentially gave the government an interest-free loan of your own money, and now they're giving it back to you without paying you any interest for the privilege of holding on to it. Getting money back feels good psychologically. Absolutely, it feels like a windfall, but ideally, your withholding should be close to accurate so that you're not overpaying throughout the year and then waiting months to get your own money back. You could have been using that money all year for savings, paying down debt, or covering expenses. If you consistently get large refunds every year, it might be worth adjusting your W-4 form with your employer to reduce your withholding so more money stays in your paycheck throughout the year. As we move forward through this tax season, this year may end up being something of a test for the IRS itself as an institution. Can the agency handle major policy shifts, significant changes to the tax code with 25% fewer people than they had before? Can a more digital, automated system still feel fair and accessible to taxpayers of all ages and technology comfort levels? Can they maintain accuracy and customer service standards while processing hundreds of millions of returns with reduced resources? We'll see how it plays out over the next few months. There will undoubtedly be problems, bottlenecks, and frustrated taxpayers. That's inevitable with changes this significant. But how the IRS responds, how they adapt, and how effectively they communicate with taxpayers will tell us a lot about the future of tax administration in this country. For now, though, the key takeaway is this, and I want to make sure this is crystal clear. January 26th is just the opening day. It's not a deadline. It's not a race. It's not a competition to see who can file first. Preparation, patience, and precision matter more this year than they have in a long time, possibly more than they've ever mattered in recent memory. Let me give you some practical, actionable steps you can take right now to prepare for filing season and set yourself up for success. Step 1. Gather all your documents. Don't file until you have everything. That means all W-2 forms from every employer you worked for during 2025, all 1099 forms for contract work, investment income, retirement distributions, or other income sources, all receipts and documentation for deductions you plan to claim, and all forms related to credits like education expenses, energy improvements, or childcare costs. If you're missing something, wait for it. Don't estimate. Don't guess. Don't assume you can file now and fix it later. Get everything first. Step 2. Understand which deductions apply to you. Review the new deductions we discussed. Do you earn tip income? Did you work overtime? Do you have a car loan? If so, make sure you understand how to claim these deductions correctly and what documentation you need. Don't just assume you qualify. Read the requirements carefully, or better yet, talk to a tax professional who can guide you. Step 3. Set up direct deposit. If you don't already have direct deposit set up for your refund, do it now. Get your bank account routing number and account number ready. Make sure you enter them correctly on your return. This will speed up your refund significantly and eliminate the risk of lost or stolen checks. Step 4. Consider using tax software or a professional. If your tax situation is even moderately complex, if you have multiple income sources, own a home, have investments, or are claiming new deductions you're not familiar with, consider using tax preparation software or hiring a qualified tax professional. The cost of software or a preparer is often worth it to avoid mistakes that could cost you far more in delayed refunds or penalties. Step 5. Review before you submit. Before you hit submit, review everything one more time. Check your social security number. Check your bank account numbers. Check your math. Make sure you've signed electronically where required. Verify that all your income is reported. It takes an extra 10 or 15 minutes, but it could save you weeks or months of problems. Step 6. Track your refund. After you file, use the IRS Where's My Refund tool on their website or the IRS To Go mobile app to track your refund status. You can typically check this about 24 hours after e-filing. If there's a problem or delay, you'll see it there first, and you can take action sooner rather than waiting weeks wondering where your money is. Let's also briefly address the other side of this. What if you owe taxes instead of getting a refund? First, don't panic. Owing taxes doesn't mean you did anything wrong. It might mean your withholding was too low, you had income that wasn't subject to withholding, or you didn't make estimated tax payments if you're self-employed. If you owe, you still need to file by April 15th and pay by April 15th to avoid penalties. If you can't pay the full amount, file anyway and pay as much as you can. The IRS offers payment plans, and the penalties for not filing are much higher than the penalties for not paying in full. You can set up a payment plan online through the IRS website, and in many cases, you can qualify for a plan without even talking to anyone. The interest and penalties will accrue on the unpaid balance, but it's manageable. Whatever you do, don't just ignore it. That only makes things worse. There are a few special situations worth mentioning that could affect your return this year. If you earned income through platforms like Uber, Lyft, DoorDash, Instacart, or similar services, make sure you receive all your 1099 forms. These companies are required to send them, but sometimes they're delayed or sent electronically and easy to miss. Also, remember that you can deduct business expenses related to this work, including mileage, phone costs, and supplies. Keep good records and claim these deductions to lower your taxable income. If you received any economic impact payments or advanced child tax credit payments in 2025, you'll need to reconcile those on your return. The IRS should have sent you letters with the amounts, but if you didn't get them or lost them, you can find the information in your IRS online account. If you received unemployment benefits at any time during 2025, that income is taxable. You should receive a 1099-G form showing how much you received. Make sure to report it on your return. If you bought, sold, traded, or earned cryptocurrency in 2025, you need to report it. The IRS has been cracking down on crypto reporting, and failing to report it can result in audits and penalties. I know tax season can feel overwhelming, especially with all these changes this year, but here's the thing, you can do this. Millions of people file their taxes successfully every year, and you can too. The key is to not rush, to stay organized, to ask for help when you need it, and to take advantage of the resources available to you. If you haven't shared your thoughts yet, I'd love to hear from you. Jump into the comments and let me know how you usually approach tax season. Do you file early? Do you wait? Do you do it yourself or hire someone? Your input helps shape what we talk about in future videos here on Move and Earn Us, and it helps build this community where we can all learn from each other. So take your time, gather all your documents, make sure you understand the new rules and deductions, set up direct deposit, double check everything before you file, and don't feel pressured to rush just because filing season opened on January 26th. Knowing the rules this year, understanding what's changed, and approaching this process carefully puts you in a much stronger position. You're more likely to get your full refund, less likely to have delays, and less likely to deal with problems down the road. You've got this. And if you have questions along the way, drop them in the comments, and I'll do my best to help or point you in the right direction. Good luck with your taxes this year. File carefully, file accurately. I'm Gabriel, and thanks for watching.